Welcome to This Explainer. You know, the financial education industry is worth billions of dollars. But here's a little secret. The absolute best information out there, it's completely free. Today, we're going to absolutely shatter the illusion that you need some pricey mentor or a $1,000 masterclass to figure out the stock market. I'm super excited to guide you through this because building a rock-solid foundation in stock analysis is 100% doable using only high-quality, totally free resources. Let's dive right in and build your ultimate toolkit. So let's just address the elephant in the room. Do you actually need to empty your wallet to learn the ropes? Spoiler alert, absolutely not. No way. This is exactly where we need to start because I want to empower you with the actual facts. You can build a top-tier foundational trading education without spending a dime. The digital world is literally packed with extensive, high-level materials put together by certified financial analysts, regulatory bodies, and real industry pros. You really just need to know where to look and how to structure your learning. Here's our quick roadmap for today. We're going to cover free pathways to trading, understanding the core market basics, choosing the right broker, essential free analytical tools, and finally, how to build a winning strategy. So let's get right to it. All right, Section 1, free pathways to trading. Let's unlock that knowledge. The sheer caliber of resources right at your fingertips is honestly staggering. I mean, you can systematically learn everything from basic mechanics and chart patterns to super complex stuff like options pricing, contango, and quantitative volatility models. Just looking at platforms like YouTube, Coursera, and edX, you'll find thousands of incredibly comprehensive tutorials. Then you've got Tier 1 regulated broker academies out there offering structured modules, weekly webinars, and interactive quizzes. And if you want the ultimate foundation in compliance, disclosure rules, and investor protections, you've got regulatory institutions like the SEC and FINRA providing completely free consumer guides. You are literally learning straight from the rulemakers themselves. How cool is that? Moving on to Section 2, understanding core market basics and getting into the actual mechanics. Now, before you can start successfully navigating market movements, you absolutely have to understand the underlying structure that's driving asset prices up or down. Let's start with asset classes, specifically equities versus derivatives. Equities are pretty straightforward. They represent actual, physical ownership in a corporation. You buy a stock, you literally own a tiny slice of that company. Derivatives, on the other hand, like options and futures, well, they allow you to speculate on the future price direction of an asset without ever taking physical delivery of it. It's kind of like placing a bet on a sports game. You don't own the team, right? You're just speculating on the final score. It's a really fundamental difference in how you interact with the market. Okay, next up, we need to talk about how you actually enter those markets. Let's do a quick, rapid-fire breakdown of order types. First, the market order. This one executes immediately at whatever the current available market price is. It is definitely the fastest way to get in or out, but here's the catch. You take whatever price the market is offering in that exact split second. Then we have the limit order. Think of this as an instruction that only triggers execution when the market actually reaches your specified, predetermined price level. So it gives you a lot more control over your entry price. But keep in mind, there's absolutely no guarantee the market will ever actually reach your level to fill that order. And here is perhaps the single most important definition in your entire toolkit, the stop-loss order. This order automatically closes a position at a predetermined price. Listen, it is the absolute most critical tool you have for capping your downside risk. If a trade starts going against you, the stop-loss steps right in to protect your capital. You never want to trade without one. Another vital mechanic to grasp is time. You see, stock exchanges operate during specific regional hours, mainly New York, London, and Tokyo. So why does this matter? Well, the crucial point here is that when these sessions overlap, those crossovers inject really sharp spikes in trading volume and volatility. Every single price tick on your chart during these overlaps is basically an intense, ongoing negotiation between buyers representing demand and sellers representing supply. So those overlap windows, those are exactly the times you really want to be paying the closest attention. All right, moving into Section 3, choosing the right broker and finding your execution platform. Now, when you're evaluating free platforms, you absolutely must prioritize brokers that are regulated by strict oversight bodies, places like the FCA in the UK, ASIC in Australia, or CISEC in Cyprus. They have to adhere to strict compliance and maintain segregated client funds, which keeps your money safe. And as you can see, there's no shortage of options. Whether you're looking at XTB's zero commission on real stocks, AvaTrade's competitive spreads, or taking advantage of the unlimited demos from Capital.com and IC Markets. The point is, there's a huge abundance of low-cost, highly regulated brokers out there ready to give you a safe sandbox to play in. Let's jump to Section 4, Essential Free Analytical Tools. It's time to level the playing field. Okay, this is where it gets really exciting. Modern retail traders now have access to incredibly sophisticated financial tech that, honestly, used to be reserved exclusively for big institutional desks. Your free toolkit is so powerful now. Need charting? TradingView is the industry standard with super flexible candlestick charts and custom screeners. Want to dig into fundamental data? Yahoo Finance and the SEC Edgar database give you corporate filings and macroeconomic tracking completely for free. And when you want to spot trends, just pull up your simple and exponential moving averages. You can use the Relative Strength Index, or RSI, to spot overbought or oversold zones, and track volume profiles to figure out exactly where the massive institutional supply and demand zones are hiding. It is quite literally a Wall Street arsenal, and it's entirely free. And finally, Section 5, Building a Winning Strategy. We are choosing rules over emotion. I actually want to slow down our pace just a bit right here, because this is the exact spot where so many traders fail. Spontaneous trades driven by emotion, they will wipe you out, for sure. Instead, you need to adopt this strict 4-step framework. Step 1, define the market context. Is the broader S&P 500 trending up, down, or just going sideways? You always want to trade in alignment with the macro trend to boost your win rate. Step 2, establish technical entry rules. Pick verifiable conditions, like, say, only entering a long position when a 20-period exponential moving average crosses above a 50-period moving average while volume is actively expanding. Step 3, set strict exit parameters before you ever enter the trade. And Step 4, practice with demo trading. Validate all those rules completely risk-free. Let's circle back to Step 3 for a second, your exits and your risk, because guys, this number is everything, 1 to 2%. You must place your protective stop loss beyond structural price swings, and you absolutely must strictly limit the risk on any single trade to just 1 to 2% of your overall portfolio balance. Why? Because if you do this, a string of losing trades won't wipe you out. You survive to trade another day. It's really that simple. And regarding Step 4, demo trading. 50 to 100, that is the vital number of paper trades you need to execute in a simulated demo account. Please do not skip this. By running 50 to 100 simulated trades, you collect real, actionable performance metrics. You get to calculate your strategy's exact win rate, and you get to fine-tune your execution speed under live market conditions before you ever risk a single dollar of your real capital. This is exactly how you prove to yourself that your system actually works. So, to bring it all together, mastering the stock market is definitely not some get-rich-quick overnight scheme. It's a continuous journey. You build a sustainable foundation by leveraging structured free education, using high-performance analytical tools, and refining your methodology inside a risk-free demo environment. Prioritize risk management above absolutely everything else. Keep detailed trade logs so you can actually track your performance, and only, and I mean only, transition to live capital after you've demonstrated consistent profitability in your simulation. I'm going to leave you with this final challenge. Will you conquer the demo before you risk your capital? The tools are all out there, the education is completely free, and those demo accounts are just waiting for you. Now it's totally up to you to apply the discipline. Thank you so much for joining me for this explainer. Now get out there, start exploring those amazing free resources, and happy learning.